breakout in gold, second strong day in a row. Hallelujah. Whoever thought we would see that again? If you say, wait a minute, this has happened in the past month, and every time we broke down after we had a couple or 3 strong days in gold, I gotta say, this time it's different. And I will show you exactly why. Let's get into it. Welcome to Hot Trades of the Day, your show for swing trading ideas for the coming days, weeks, and month. Hi, my name is Danny Wilhelmi. Welcome to Hot Trades of the Day. Quick housekeeping. Friday, Rick Rule interview. It's gonna be a good one. Second, because I get always asked, I said on yesterday's show, when we saw the strong gold price in European trading, I'm gonna add to my gold miner positions because I believe that the percentages of low 4,000 is in versus undercut are shifting now. And I get always asked, hey, did you follow through on this? Yes, of course. If I say it on the channel, that's what I'm gonna do. I did not get filled. Missed one position order by 1 meager cent and the other one by 2 cents. Well, that happens. That's life. Now I probably gonna run behind the bus and hope for it to stop and let me on. Let's get to gold. So, second strong day in Asian European trading. So far, again, as I said in yesterday's video, and if you missed that video, hit the subscribe button. We gotta wait what the US does, especially last hour. We know the drill, but it looks very good. Looks like a confirmation. That would mean we have 3 out of 4 green days and 2 in a row. Now, they're the bears that come out and say, well, hold on. We have had green days before, 2 right here, right, about a week ago, though the second one was way weaker, as you can see. We didn't even make a new intraday high, which we are doing today. So I don't even count this one. But if you say, well, look at this one right here, right? 3 green candles in a row and look what happened afterwards. Or here, where we basically had, well, let's count this as a green candle. 4 green candles in a row and look what happens after this. I'm not seeing what you are seeing. I'm saying, okay, but there are 2 factors that you need to pay attention to that make this different. Actually, it's even 3 if we count the double bottom. All right. And you're familiar with the double bottom if you watched yesterday's video. Second thing that's different, we're breaking the downtrend. We're breaking the downtrend that has been in place since the beginning of March. So this is significant. That has been in place since, let's go through this, April, May, June, July. So 4-month downtrend getting broken, that is something. The other thing that's different, because as you can see here, we're below it, then doinked off it, sell off. Here, run up, doinked off it, sell off. Right? Even if you take this one right here, which strong up move, doinked off it, sell off. Here, 2 green candles in a row, doinked off it, sell off. Here, broke the downtrend. This is different, ladies and gentlemen. Also, if I add the 20-day moving average, which I usually do not like personally, I like the 50 more for gold, and I'm going to talk about this in 1 second, but I know that for shorter term traders, the 20-day is really important. And as you can see, we broke the 20-day moving average, the brown line that you see here, yesterday as well with the downtrend. We basically broke 3 resistance areas yesterday. Downtrend, 20-day, and the 4,070. That's a powerful move. And again, if you compare this with here, right? We tried to break the 20 and didn't make it, sold off. Here we had the nice green candles, but we were always below the 20, never broke the 20. Right? This is this area right here. Same thing with this one, where we had this run up. We tried to break the 20, we bounced above it real quickly and then rolled over right away. We never really broke it with authority. Right now, looks like we're doing this. So this is a different setup that we're seeing right now. And this is important to me because we're going to have a lot of people right now that are so paralyzed after this long bear market that they're sitting on their hands and say, well, I've seen this movie before. I'm not jumping in. What I'm trying to tell you is this is a different movie. I'm not saying this is the end of the correction. We will see what's going to happen, and I'm going to outline what I think is going to happen in a minute. But I want to increase your awareness, and that's why I tried to buy yesterday, and as I just told you before, that didn't really work out very well. And that happens. That's part of the market. The secret is not that you never make mistakes. The secret is how do you react after you made the mistakes. Everybody makes mistakes. Or things just, no luck. If you miss an order by 1 cent, that's really kind of like, yeah, you got it right, but you're maybe a little too greedy, or you just had bad luck. In my case, probably too greedy. So why don't I like the 20? Let's talk about that. I like the 50-day moving average. And the reason why I don't like the 20 is it's very incorrect. It gives you a lot of fake signals that suck you in too early. Now, if you're a day trader or a short-term trader and you don't mind to get stopped out quickly, you're basically saying, well, if I do 3 trades and I got stopped out twice quickly with smaller losses, but then I get one bigger move right, fair enough, fair strategy. I've seen this work. It's not for me. I have better things to do in my life than to be miserable about being stopped out at twice and then being right once, but that's okay. But as you can see, if we zoom out, you see that the 20 gives you a lot of, it gives you moves early, for example, like this waterfall sell-off, earlier than the 50-day, the purple line right here. But overall, you get a lot of fake signals, right? Okay, so you got out here after the 20-day, but then you got back in here, and you probably got stopped out here, and then you had a fake breakout here that didn't really look very good, and then you had a fake breakout here that cost you a lot of money. So, and then on the downside, obviously here we're above the 20, you got this fake out bear trap right here and more bear traps here, even though these I'm okay with because they were just undercuts and liquidity grabs, and the next day we jumped right back in. But you can see right here, you missed the whole bottoming phase probably. If you were, it's very incorrect. While the 50 gives us less signals, the purple line, but if it gives us a signal, boy, it's meaningful. Right here, bull signal in the 50, let us run all the way up. We still got out pretty good, right? Below the 50. And then the 50 led us all the way down. Now, you will always be a little late on the long side and the short side, but not too late with the 50-day moving average in gold in this recent rally. This is the most important thing. I do not care what happened with the 50-day in 2018 or 16 because we're in a gold bear market. What do I care what the 50-day did then? It's a completely different segment. We're in a gold bull market now. And here, the signals so far have been very good on the 50-day. So that's why I care about it more than the 20-day, but acknowledging that the 20-day is very important for the more short-term traders. They're going to jump on board now, especially if Google comes out today with bad earnings or bad outlook or any type of comments in a conference call that put the massive AI spending into question. Then the market's really going to start to shake in the tech sector and overall, and people are going to look around and say, what looks good? The traders, right? What looks good? Oh, gold just broke the 20. Let's go along, trend following. That would bring more capital in, which for us as the more long-term investors and long-term swing traders, it's perfect. Because every strong day increases our chances that we are indeed in the bottoming phase, and 4K may be it. So, what do I think is going to happen right now? Well, we got a lot of weird factors that are going on right now. The first one is oil. Monster breakout move to the upside. Short squeeze deluxe. Remember what I told you in yesterday's video? I said, do not short oil because it's gonna blow up in your flamethrower to the face. Because it takes one bad news and oil is gonna go. Look what happened to oil in the past, in yesterday and today. Brutal if you were short. And the situation in oil is improving dramatically. Now, we are clearly overbought, but it doesn't matter if we have a short squeeze. It doesn't matter if we have geopolitical news that's going to push people into buying oil, or again, covering their oil short positions. But if oil goes up, why is gold going up? That doesn't make any sense. Or the dollar, which showed surprising strength in yesterday's trading. Actually, even the past 2-3 days, to be honest with you. And really looks like it wants to break the downtrend. Makes zero sense to me, especially considering the yen is going up as well. There's a lot of weird movement in the markets right now that does not make sense altogether. And that usually means that a lot of people are getting caught on the wrong side. And that's why I always try to say here at Hot Trades of Today, look, we don't need to dance at every party. We pick our battles, and we try to stay away from the moves where we might have to take unnecessary risk and uncalculated risk, for example, like oil. But this is a very, very unique and weird constellation of these different factors that usually have very different correlations historically, or in a more recent time, which means oil and gold. So what do we make of it? Well, we'll stay away. We don't pretend to be smarter than the market. We're not going to tell the market, you guys are wrong. We're just going to wait and see. But I think, and I see gold improving, but I don't think we're going to go to the moon. Nothing like it. We're not there. One of the reasons is because we don't have the support of a falling dollar yet. We have the higher oil prices. Yes, that's going to fire up inflation, but it's also going to increase the rate hike probabilities and decrease the rate cut probabilities, though that is probably off the table. I would assume at this point in 2026 that the gold market has basically priced out the rate cut possibilities in the near future. Maybe one surprise rate cut before the midterms, but that would be it. So I expect this bottoming formation to continue at least for a little while, but the selling pressure is fading out. If we get an undercut now in gold, it will only be because institutions are trying to trigger the stops. It will not be general capitulation selling, because if that would have been the case, we would have seen it already. This would have been the capitulation selling right here. After we closed below 4,000, the next day, that would have been the people just selling off and just saying, that's it, gold is dead, I'm giving up. And that didn't happen. We didn't even make a new intraday low. So we need to adjust accordingly, even though the circumstances surrounding gold are wild. I can see, let me see where I find the cool arrows. Here we go. I can see, or let's see, the development that I'm hoping for is this. We're going to run up to 4,215, which in this area will also be the 50-day. That'll probably be too much because we're not euphoric in gold yet. We get a correction either to this area right here, as you can see, and I'll draw it in a second. So 4,000, basically where we are right now, 4,120-ish to 25, or all the way back, which I would prefer, and that would be perfect, retest of 4,070, and then we're going to go and see and party from there. Which means if I'm right with this, and I'm not right all the time, not even close, but just by sentiment, right? I like to go by sentiment a lot. What does the market feel? And with the market, I mean the mainstream investor. Not us. We're in the bubble. We're in the gold bubble, right? We know the fundamentals. The majority of the mainstream investors don't, and the institutions don't care. They just come into gold because they want to make money. Which, fair enough. That's why I'm in gold as well. But you know what I mean. So they're just going to do trend following. But after all this, since the end of January, the sentiment is just not switching back to bullish for the mainstream investors like this. Here it did, and that's why we saw the big intraday reversal. Even here it did, and that's why we saw the big intraday reversal. But as you can see, when we drop below the 200, we got the sell-off, and we got another sell-off. We didn't get this anymore. We didn't get this anymore, which shows us, okay, when we broke the 200 and we broke that uptrend, that was when sentiment really, really completely shifted. It did before because we see that there was no strength on the buy side anymore, right? Here, after we ran up to the 50-day, you can see there was more and more weakness on the buy side. Now, that's going to take a minute to rebuild this greed. We're not going to get immediate greed. If you expect us to run back up to 5,000, that is extreme. Well, it could happen, but if that happens, there's a serious problem then in the markets. Because from the sentiment wise, that's unreasonable to see a 25%, 22% move in gold happening this fast. What's more realistic is that we're going to proceed with the bottoming a little more, which again is good. This is positive. The longer every day is working in our favor, right? Every day is working in our favor. The longer this bottoming process goes on, especially above 4,000, the stickier it gets, and the more people will take a look at gold and say, oh, wait, there's something happening in gold. Okay, maybe I should put that on the watch list. Maybe I should start opening a small position. And then if we break the 50-day, that will be the first big trigger signal. And it'll be a bigger one because it will also mean 4,215. Okay, so what do we do now? Well, if you haven't opened up or added to some mining stocks, and as I told you before, focus on the ones that have shown high relative strength. Then you should still make a run to add for some of these positions, in my opinion. But I'm not your financial advisor. I don't know what you're going to do with your money. Maybe you're going to buy Pokemon cards. I saw the YouTube videos. Wild what people are buying for Pokemon cards. It's like some purple dragon that's like sending fire stars or something out of his mouth. And it's like, yeah, I'll pay $30,000 for it, which is like 7 ounces of gold. Wild. I pay 7 ounces for the purple dragon. I'm in the wrong business. I tell you that much. Wild. If you want to get your head blown off, seriously, like Google, I don't know, Pokemon card shows. I don't know what you Google on YouTube, but it'll pop right up, pop on trading cards. Crazy, crazy, crazy what's going on there. By the way, clearly a bubble too. But back to gold. This is my strategy. I'm going to increase my positions. Am I going to go in 100%? No. Because I still believe that we're going to get retests. The sentiment is not like it was at the end of January. It's not like it was at the end of February when we saw the massive intraday rebounds here and here. But I don't believe you should risk, or anybody should risk, or I should risk being left out in the cold with no position in case we do break the 50 right away. Because that is possible. Is it probable with this sentiment, with this dollar, with this oil price? I don't think so, but it's possible. And again, one of the biggest mistakes private investors make is they look at a setup binary and they don't look at it in terms of probability. And they don't think and don't ask themselves, okay, what should I do if A happens? Let's say we get the undercut. Then the answer is I'm going to buy all the mining stocks I can. Okay, fair enough. But what are you going to do if B happens? How are you going to position yourself today if scenario B happens, and B being we're going to break the 50-day right away? Because then we will see a big move. And all of a sudden, we're going to be at 4,300, 4,400. The mining stocks are going to be up 20%, 25% higher because the charts look like a German tank in 1944, completely bombed out. What are you going to do then? You're probably going to cry in the fetal position and not buy. And then all of a sudden, we're not going down anymore, and you're going to chase and you're going to be on the wrong side. We endured all this suffering of 5 months now, 6 months almost. And it was not great, to say the least. But you know what? It'll be okay if we grab the payoff. But if we don't invest near the lows, we don't even get the payoff. We get all the pain for 6 months and no payoff in the end. It's like the Disney movie, right? The knight, he fights all the dragons, he fights all the skeletons. He gets to the castle, and then the princess is not even kissing him anymore. And the knight is like, well, this sucked. I suffered through all the dragons and the skeletons, and I don't even get the happy end. So that is why I'm going to increase, personally, that's my personal strategy. It doesn't have to be your personal strategy. That's why I'm going to increase my positions now. Not dramatically, we're not at 100% yet. But I look at this gold chart and I say, hey, things are shifting. Probabilities are shifting. And we need to adjust our portfolio and our buying strategy accordingly. It will be extremely volatile in the coming weeks because of the earnings season in the equity markets, which could affect the more risky areas of the mining sector, especially if gold, silver, and copper show weakness. But boy, have you seen the copper chart? That's what I wanted to talk about actually today first. There's no weakness in the copper chart. So as long as gold is holding up, as silver is holding up, as copper is holding up, as long as that happens, the pressure on the junior producers, senior producers won't be very severe if we get pressure in the tech stocks. But the volatility can be higher. It will be high with the more tech adjacent commodities like lithium and uranium, rare earth miners, because those are highly speculative. But with the mainstream mining stocks, gold, silver, copper, critical metals, shouldn't be so bad. So people in the equity markets, therefore, going to look at gold if gold is holding up. And they're going to look at the mining stocks and say, these stocks are really bombed out. And boy, they are making a lot of money, those producers. Maybe I should buy that instead of some AI stock. If that happens, how are you prepared for this possibility? My strategy, I'll increase my investments and therefore am prepared for this move and have cash left if something goes completely the other way. Which again, every day that we're above the downtrend now, that has been in place since March, significant. Every day that we're going to be above the 20-day moving average with a new high, significant. Going to attract more and more short-term trading money. And you say, yeah, well, that short-term trading money is going to leave short-term once we turn around. Yes, but every green candle, every, again, new high that we make, that adds to the overall chart picture and the bottoming phase that we are clearly in. And that will therefore then attract longer-term capital. That is it for today. Have a great day. See you tomorrow. Bye-bye.